Thank you for joining our webinar. And remember that we do these every third Thursday of the month. There are several webinars that are already scheduled, but we invite you to contact us if you have ideas for other webinars. We'd love to hear your suggestions. Today, we're going to talk about what I think is a very hot topic, and that is keeping high-risk customers while keeping the regulators happy. Our story begins really in 2011 as there is a concerted effort of the regulatory agencies, including the OCC, the FDIC, the FinCEN, and the Federal Reserve. The idea here was that these agencies expanded the definition of what a high-risk customer was, and in particular focused on third-party payment processors and money service businesses. As they expanded this definition, the FDIC in 2011 published a list of what they considered to be high-risk businesses. This list became known as Operation Choke Point. Again, the idea here is that if it's a high-risk business, there was a great deal of monitoring that was necessary, a great deal of compliance that was necessary. So this particular focus was taken to heart by bank regulators in general, and it led to a lot of banks being criticized for having these customers. As a direct result of this Operation Choke Point, eventually a lot of banks decided that having an MSB or a third-party payment processor simply wasn't worth the risk. So high-risk customers became anathema. The demands for monitoring on banks became absolutely overwhelming, so that high risk eventually became high stress. There were even cases where the examiners insisted that banks know information about customers of their customers. A quick example, we were at a bank consulting with it when the bank had a customer who was a landlord. The landlord mentioned to the loan officer at one point in time that he had a tenant whom he suspected of being a drug dealer. The loan officer made a note of this conversation in the loan file. The examiners picked up this conversation and insisted that the bank file a SAR on the tenant. The bank objected at one point in time and said that, well, it wasn't their customer. They really didn't know that much about this guy, but eventually the bank decided, well, to go along and get along, we'll agree to file the SAR. Then the examiners said, well, since you failed to file the SAR, it's a pillar violation. So it became just a nightmare for this particular bank. That's an example of how far this got. So that bank, like many other banks, decided rather than doing so much monitoring and overwhelming administration, the idea would be to just drop this customer and all customers like them. But there's something good that happened as time went along. First and foremost, it's important to note that the FFIEC BSA exam manual allows banks to make their own decisions about when they're going to keep high-risk customers. That's actually always been the case, and I'll talk a little bit more about that in a bit. But even though that is the case, the custom has never been that. In other words, the custom has been the examiners kind of drive what the bank does and who they keep as their high-risk customers. But here's the thing. In the case of BSA, the desire to monitor and mitigate risk had the unintended consequence of shutting out entire industries that are often critical to the unbanked or underbanked communities. MSBs, such as combination grocery stores and check cashers, often service the bank and remittance service for migrant workers and expatriates of other countries. When a local bank makes a decision to stop providing these services, the customers of the MSB are forced into transactions with entities such as payday lenders and check cashing outfits. In this case, the changes started when the House of Representatives produced a report in May of 2014. And in that report, they pointed out that Operation Choke Point was really cutting off legitimate businesses and making banks run away from these sort of operations. First, in November of 2014, FinCEN released a statement that described what their stance was. They said that there's a concern that banks are indiscriminately terminating the accounts of all MSBs or refusing to open accounts for any MSBs, thereby eliminating them as a category of customers. They went on to say such a wholesale approach runs counter to the expectation that financial institutions can and should assess the risk of customers on a case-by-case basis. So I emphasize that case-by-case because, again, I want to point out that banks do have the right to keep high-risk customers. The FDIC goes further. Now, remember that I am a former regulator, and so I do speak regulator, so you do have to read between the lines a tad. But in this financial institution letter 5-2015, the FDIC makes several statements. They go on to say individual customers within broader customer categories present varying degrees of risk. Accordingly, the FDIC encourages institutions to take a risk-based approach in assessing individual customer relationships rather than declining to provide banking services to entire categories of customers without regard to the risk presented by the individual customer or the financial institution's ability to manage the risk. Now, that's the statement from the FDIC in January of 2015, but like they used to say in the old commercials, there's more. If you hang on, wait, there's more, and that is the FFIEC DSA Examination Manual. This is taken directly from the manual. You'll note the part that's highlighted. The bank should not be criticized for the failure to file a SAR unless failure is significant or accompanied by evidence of bad faith. Now, here's the rub, the significant or accompanied by evidence of bad faith. Here's what the examiners are saying, that there are circumstances under which you are allowed to keep your high-risk customers, and they have nothing to say. First and foremost, you have to know your customers from top to bottom. You have to know what it is they're doing, how it is they work, and what is and isn't suspicious. It's really, really important that you know why it is a customer is considered high risk. Are they a cash-intensive business? Do they send a lot of remittances? For whatever reason that you've identified that they're high risk, that's what you need to monitor for. So a high cash-intensive business, you should be looking at their cash and making sure that it matches what you think it should. Here we recommend as a best practice using the NACIS codes. The NACIS system identifies different businesses and allows you to keep track and compare your business with individual industries. So it's a best practice to use that as part of your monitoring activities. In addition, it's a best practice to do internet searches on your customers on a regular basis. Even the best of people have bad times, so it's good to know if there's any news out there on the internet that might impact your particular customer. Really, really, really important that you pay attention to what your transactions that you've monitored tell you. If you look at the FinCEN bulletin from May of 2015, where they discussed some recent prosecutions based on suspicious activity filings, you'll note there's a case where one bank noted its customer was making deposits at a branch where the customer itself didn't really have any business or shouldn't have had any business. That started, the SAR filing started an investigation that led to a federal prosecution. In another case, the bank noticed that their customer was writing a number of checks from one business to the other, but the business was owned by the same person and at the same address. That SAR that was filed on that ended up leading to a huge investigation and several arrests in the Los Angeles area. So the point here is make sure that when you're looking at transactions that you know the story that they're telling. I'd also like to point out that loan officers are a really good source of information. If your customer has a loan, it's a good idea to get the loan officer involved in collection of information. After all, you've loaned him a great deal of money, and you want to make sure you get paid back. So the loan officer really knows those customers, his or her customers, very, very well. Make sure that if there's incomplete information or unreasonable information, there's follow-up on it. Don't have information that leaves a loose end in your files. So some of the things you need to do to address having high-risk customers, of course, the first thing is having the risk assessment. It has to be comprehensive. It has to discuss what the risk appetite of the bank is, the things that this bank has decided, your bank has decided that are risky, but you will still tolerate, and what you've done to mitigate those risks. And this is something new here, too. The second thing is to make sure that you have both a data validation and an annual model validation. The data validation is pretty straightforward. It's pretty much what it sounds like. It's the process of making sure that the information in your monitoring software is being accurately and completely loaded from your core system. This portion of the guidance is the most straightforward, but there's also this model validation. And there, I think, you have to make sure that the software that you're using has established rules that match your risk assessment. So those things that you put in your risk assessment as areas that need to be watched are areas that your software should be attuned to. So the model validation is having a third party come in and make sure that your rules of your software have been set to properly match your risk assessment. Now, complete written documentation. When I was coming up as a young examiner, we were always taught that if it's not in writing, it doesn't exist and it doesn't happen. So make sure that you put everything in writing. We suggest that development of a compliance committee. It's a good idea to have senior management at a bank put together into a compliance committee, because that way you can have credible challenges of the decisions that you make, document the discussions, and make them that much stronger. Make sure that you understand the businesses of all your customers. If you do not understand what they're doing, do not bank them. Quick example, it was the Office of Thrift Supervision that was monitoring AIG, who was doing a lot of really sophisticated insurance swaps and transactions. And I think you know the rest because it's history. That's what led in large part to the financial downturn of 2008 and beyond. So if you don't know the business, don't bank it. To make the case for why it is you should keep your high-risk customers, we suggest you have, first of all, a description of the business and your understanding of it. Make sure that you document, here's what they're doing, here's why we feel comfortable that we know what they're doing. Having direct conversations with your customer is an excellent idea. They don't have to be interrogations. You can ask simple questions and get a ton of information. Oh, you're going on vacation. Oh, maybe you're thinking about starting a new branch, and so forth. But having regular conversations that are documented with the customer is an excellent idea. Of course, a picture is worth 1,000 words. So going on site on a regular basis, taking a picture, making sure that everything is as it should be. You'd be surprised what you find out. You might go to your customer, take a picture, and find out there's a new sign that says, "We cash checks," and you didn't know anything about that. Always a good idea to do regular on-site visits. Again, the monitoring tools, making sure that your software, your BSA AML software, is looking for the things that you have determined are risky, and make sure that it's giving you the proper amount of information you need. Always important to consider the what-ifs. What's the worst thing that could happen? What if the owner starts to have a gambling problem? How will I be able to know that? Always good to have those scenarios in mind. Again, we recommend having a compliance committee. In this case, 2, maybe 3 heads are better than 1. It's a good idea to have somebody ask you questions that perhaps you hadn't thought about, and make sure that they challenge your decisions so that you can defend them in the best possible way. Remember, there's no need to make sweeping denials of customers. In fact, the guidance from the regulator says that you should not do that, and you should take each customer on a case-by-case basis. Remember also that you have the power, you have the FFIC manual that gives you the right to make decisions on your own. So you can keep whatever customer you have determined you want to keep. Use common sense. If something doesn't sound right, if it doesn't feel right, if somebody's doing something, they're opening 5 different accounts when they really don't seem to need 5 different accounts, let your spider senses tingle and go ahead and close the account. Use common sense always. I can't overemphasize this. If you don't understand the business, don't bank it. Don't have a customer that's way ahead of you. It's just not worth the risk. Last but not least, always, always, always document what you are doing. If it's not in writing, it doesn't exist. Thank you.